right? And what the court decision really turned on in the Supreme Court was whether previous case law referred to de jure control, so you had to be the legal shareholder, right? And the Supreme Court here said, well, actually, you were not the legal shareholder, but you were very close, and that's why we apply the GAAR, right? So what the Supreme Court says is, first, the text of Article 111 references control, which has been interpreted as referring to de jure control, right? There are reasons why Parliament chose the de jure control test. It is a clearer benchmark than the de facto control, meaning greater certainty for the majority of transactions, right? But then the court goes on to say, however, the provision's rationale is not fully captured by the de jure test. Rather, the rationale of Article 111 is illuminated by relating provisions which both extend and restrict the circumstances in which an acquisition of control had occurred, including by looking beyond the standard documentation under the de jure control test. These provisions suggest that the de jure control test is not a perfect reflection of the complete explanation of the mischief that Parliament sought to address. And because Parliament tried to address more, it's okay for us to not look at de jure controls, what the court says. Matco achieved the functional equivalent of an acquisition of control through the investment agreement while circumventing Article 111, because the transactions dismembered the rights and benefits that would normally flow from being a controlling shareholder. First, it contracted for the ability to select Dean Knight's directors. Second, the investment agreement placed severe restrictions on the powers of the board of directors. Third, the transactions allowed Matco to reap significant financial benefits whilst depriving Newco, the majority voting shareholder on paper, of each of the core rights that it could ordinarily have exercised. The complex series of transactions and the flexibility built into the investment agreement were necessarily only because the contracting parties sought to achieve the very mischief that Article 111 was intended to prevent. So the majority of the Supreme Court says, this is abuse. We apply the GAAR. We don't care that it's not de jure control, and you cannot get the deduction. One judge disagreed, and the dissenting opinion says the avoidance of transactions did not frustrate the rationale of Article 111 and therefore do not amount to abuse. The GAAR requires a careful balance between the interests of the taxpayer and minimizing his or her taxes and the legislative interest of ensuring the integrity of the income tax system. Despite Parliament's unambiguous adoption of the de jure control test, the majority has opted for an ad hoc approach that expands the concept of control based on a wide array of operational factors. And what I find interesting about this is, I mean, I don't think Parliament, we looked at Article 111, it doesn't say legal control, right? So the court interpreted it as legal control, maybe based on parliamentary history, but I'm not quite sure where the dissenting judge's text comes from that it says the unambiguous adoption of de jure control. I think that's what the courts have made of it. The key question is whether Parliament specifically intended to prevent or permit a certain type of transaction. Where an anti-avoidance provision has been carefully crafted to include some situations and exclude others, it's reasonable to infer that Parliament chose to limit its scope accordingly. If Parliament drafts a specific anti-avoidance provision in a way that keeps a highly foreseeable gap open, the gap is more likely to be intentional and relying on it should not be considered abusive. So Parliament, so what the judge says here is, you know, what Matco has done was probably foreseen by Parliament. They did not legislate against it, and therefore you can't apply the abuse rule. And then he ends with an interesting sentence. He says, in my view, Matco did not really acquire Dean's Knight in any practical sense. The tax court found that there was no trade or transfer of non-capital losses. Matco did not use Dean's non-capital loss for its own benefit. The post-IPO shareholders were the only ones that directly benefit from the benefits of the ownership. It requires a great leap of logic to infer that Matco acquired Dean's Knight. And I think we'll see this in a moment, but what the dissenting judge hints at here is, yes, you know, Newco or the appellant did get to use $60 million of its tax losses carried forward. But by the time he did so, the benefit of that went to the 10 million shares that were issued at the IPO. It did not go to the shares that Newco once held and that now are held by Matco, because there were many times more shareholders or shares issued under the IPO than what Matco held for itself. And this brings me to the Tax Court of Canada opinion, because here they really put numbers to it, right? They say in the tax court, which decided for the taxpayer and not for the revenue, said, furthermore, I find nothing to support the contention that Matco could only profit from the monetization of the appellant's tax attributes if it acquired the remaining shares. So these shares that it didn't acquire through the conversion of the note, but that were the remaining voting shares that Newco had, right? After the conversion of convertible debenture, for which it paid 2.96, so 3 million, Matco held 35% of the voting shares and 100% of the non-voting shares, and those shares were given a value of $4 million, more than $4 million at the IPO. So Matco made $1 million out of this transaction, right? Clearly, Matco earned a significant profit without acquiring remaining shares. And remember, without the remaining shares, it did not have control, right? I would also note that the additional profit it stood to make by acquiring the remaining shares, and this is the main issue, was approximately $200,000, right? Because Matco had to pay Newco $800,000. These 65% of, before the IPO 65%, right? Shares that Newco held had a market value of 1 million. Matco acquired them for 800,000. Newco sold them because it needed the cash at the time, and it was under an IPO lockup, and it couldn't otherwise sell the shares, and that's why it did it. So the tax court judge concludes and says, in my view, Matco was careful to structure the transactions to not create any right to acquire the remaining shares in order to avoid an acquisition of control under the Act. So it did think of the Act, right? It is more likely than not that it preferred to give up some of the upside in order to achieve this goal. So before the tax court, the taxpayer won, then they appealed, and it went to Court of Appeal, and then it went to the Supreme Court, and the Supreme Court said, no, Matco acquired control, and the business changed completely, and therefore you cannot have the tax losses carried forward under the GAAR, right? And it reminds us of another recent case from the Supreme Court of Canada where they refused to apply the GAAR, right? And this was the Alta Energy court case, where Alta Energy was a U.S. corporation. It held sandpits in Canada. The company that held it, the Alta Energy LLC, could not sell the shares in Alta Energy Partners without paying capital gains tax in Canada. So it interposed a Luxembourg company in between, and then 2 years later sold the shares in the Luxembourg company, sold the shares in Alta Energy Partners in Canada, and made a $380 million profit, right? And in that case, and I've discussed it on this channel before, the court refused to apply the GAAR to the treaty because it said, Canada entered into the treaty to attract investors. Canada never in the treaty said you cannot be a single purpose vehicle in Luxembourg with no substance. It got investors, right? And therefore it must allow the Luxembourg-Canada treaty to shelter the taxpayer from Canadian capital gains tax on the sale of the shares of Alta Energy Partners. And if we just briefly look at what the court said there, the treaty makes it clear that Canada and Luxembourg agreed that the power to tax would be allocated to Luxembourg where the conditions of the carve-out were met. There is nothing in the treaty suggesting that a single-purpose conduit corporation resident in Luxembourg cannot avail itself of the benefits of the treaty or should be denied these benefits due to some of the other considerations, such as that shareholders not being themselves resident in Luxembourg. In this case, the provisions operated as they were intended to operate. There was no abuse, and therefore GAAR cannot be applied. Okay, the court went on to say, a final note on the minister's implication that treaty shopping arrangements are inherently abusive. A broad assertion of treaty shopping does not conform to a proper GAAR analysis. The court's role is to limit the determining whether a transaction abuses the object, spirit, and purpose of a specific provision relied on by the taxpayer. It is not to rewrite statutes or tax treaties to prevent treaty shopping when the instruments do not clearly do so, right? So Alta Energy, very different decision from Dean's Knight, and it raises a number of questions that I'll end with here. One is, long-term shareholders do want to make use of the losses of their companies that have generated losses, and I'm not for myself sure whether that is empathy or whether that is a double dip, right? Because clearly the long-term shareholders have lost in their investments. However, the company which made the losses already can deduct those losses. So is this a double dip or is it not? What to me is quite clear is if you have a company that's been held for a long time and it starts making losses, and then the random investor comes in with a clever plan of how to utilize those losses other than it was intended for, that is not 100% kosher, right? And then, as far as the jury test is concerned, let's say that this was clearly an abusive case, right? And let's say that there was a de jure test. What is the role of judges then? Should they then stick to the letter of the law and allow a huge loophole even under a GAAR? And would they not then pretend to be stupid, basically, and saying, oh, but this is the letter of the law and we can't do anything else? I'm not sure. Another question is it right to assume that if Parliament addressed one abuse in detail but not another, that they were prepared to accept the other abuse, right? You can go two ways. You can either say Parliament did not address the other abuse, therefore it is not allowed until Parliament says it is, or you can say as long as Parliament does not say that the other abuse is not allowed, it must be allowed. And I wonder under which circumstances one would apply which doctrine of thought. I'm not 100% clear on this. And then, if you make an onion of this, you get the rule, then you get a GAAR. A GAAR is an exception to the rule. So should a GAAR be interpreted narrowly, or is the whole purpose of a GAAR to be interpreted within its own wording relatively broadly because it needs to cover unforeseen circumstances? And when you then do apply the GAAR, and there are exceptions to the application of the GAAR, should one then also interpret the exceptions to the application of the GAAR narrowly, because the general rule is you apply the rules as they are and you apply the exceptions narrowly? It becomes quite a layered discussion in that regard. I like what the dissenting judge raised in the issue that Matco didn't really benefit from this, because ultimately the benefit from the tax savings of the $60 million tax deduction against the taxable interest income was primarily enjoyed by the shareholders under the IPO and not by Matco, right? And I'm kind of surprised really that the Supreme Court did not pay more attention to that, because I think they did miss an important issue here. And then the last issue is, and it comes back to this de jure control, especially in English legal systems, it's very much about interpreting the literal text of the law, right? But when it comes to treaties, even English systems say that you cannot. Several courts, Australia has done it, UK has done it in Fothergill, Canada, I believe, has done it. They say treaties must be interpreted more according to their spirit than to their literal text, because they are a compromise between two states. And I wonder whether interpreting the GAAR leans somewhere in the spectrum between national law to be interpreted to the literal meaning and the letter, and treaties to be interpreted more bearing in mind the purpose and intent, and maybe GAAR somewhere in the middle, or not, because GAAR ultimately still is national law. I'm curious to hear what you think, and next week we will discuss a different case, maybe a transfer pricing case again. Bye for now.